Okay, so now the other day we talked about the fact that currencies are traded in pairs. Do you remember that?
Yes.
Yes, where I said you have a Euro USD, Euro slash USD, and you have GBP slash USD or GBP USD. It can be written any way. It can be written with slash. It can be written without a slash, right? So we said currencies are traded in pairs. So today we're going to be talking about currency pairs, explaining them in details. All right. So now currencies are basically currency pairs are quotes. It's like a currency pair. Let me write it for you. A currency pair is a quote of one pair against another, of one currency against another, one currency against another. So a currency pair is a quote of one currency against another. So in this example now, we're talking about Euro USD. This is a quote of Euro against USD, GBP against USD. So when you quote one currency against another one, you have a currency pair, NGN USD. Okay, do you recognize this one?
Yes, yes.
Okay, all right. So I just want you to know that that also exists. On some platforms, actually, you can trade on that. Okay, but it's Aboki people that trade on that very much. All right, so it basically currency pair is a quote of one currency against another. So in the first case, you have Euro USD, you are quoting the euro against the dollar, right? The second case, you're quoting the pound against the dollar. In the third case, you're quoting the naira against the dollar. Okay. So now, what does this quote mean? Sorry. What does this quote mean? It means that usually this quote will be a figure. Usually, this quote will be a figure. Now, for example, in this case, you will find you find 450 to 1, right? Do you understand that? Hello?
Hello?
Yes. Do you understand what I just wrote now? NGN
Yes,
USD.
450.
Okay, that is how much it will cost you to buy $1 with naira, right? So this is usually how
Okay.
a currency is quoted. You are quoting one currency against another. So it's basically the amount, the what it will cost you in one currency to buy another. Is basically what it will cost you, what it will cost you. Sorry, I have something on. Let me close it. So it's basically what it will cost. It will cost you. Sorry. Basically, what it will cost you in one currency to buy another one. So now, this is what a quote is. So a quote is a currency pair. A currency pair, sorry, not a currency. A currency pair. A currency pair is a quote of one currency against another. It's basically what it will cost you in one currency to buy another one. So look at this now. You have NGN USD 450 to 1. So what it means is that it will cost you 450 naira to buy $1. That is what a quote is. So basically, now many times you will find out that Another example. This one I just gave you now is for the Naira one. This one is not very popular. It's not popular. It's only popular in Nigeria, right? But then you will find a very popular one like this, Euro USD, maybe 1.13000. All right. So this price right now is the quote price for Euro USD. And what does it mean? It is this amount is what it will cost you in USD to buy Euro. This amount right now is what it will cost you in USD to get 1 euro. Okay, now I will extend this a little further so you will understand why USD euro. All right, so now whenever you have a pair like Euro USD, okay, we'll use Euro USD a lot today. When you have a pair like Euro USD, the euro in the pair is called the base currency. The base currency. Why the USD is called the quote currency. The quote currency. So whenever you have a pair, the one you have on the left-hand side of the pair, the one you have on the left-hand side of the pair is what you call the base currency. Then the one you have on the right-hand side is what you call the quote currency. Do you understand that?
Yes.
Yes. So every time you see that, you see NGN USD, the NGN is the base currency and the USD is the quote currency. All right. So now the base currency, the reason we call the first one the base currency is because it's the basis of the transaction. All right. Now, when I say transaction, I am talking of either a buy or a sell. Because if you are dealing with currency, you are either buying or selling. There's no other thing you're doing. You are buying or selling, right? So when I say transaction, I am talking about a buy or a sell. In fact, that's what transaction is now. In anything, when I say transaction, what does it mean? It means you did something, right? You bought or sold something, right?
Yes.
Hello, did you hear me?
Yes, I heard you.
Okay. So when I say transaction, and that's what I mean by buy or sell. So the euro, the currency on the left-hand side is called the base currency because that currency is the basis of the transaction, which means that if you have a pair like Euro USD and you say I'm buying Euro USD, which means you're buying, and you say I'm buying the pair. Remember, I said currencies are traded in pairs. So if you want to buy you will buy a currency pair. If you want to sell, you will sell a currency pair. All right. So in this case, now let's pick Euro USD as an example. If you want to transact in Euro USD now, you will either buy Euro USD or sell Euro USD. Okay. So in that case, now
Yes.
that is the transaction you are doing. So if you are going to make a buy transaction on Euro USD, you are basing that transaction on the euro, which is the base currency. So the base currency is the basis of the transaction, which means that if you are buying Euro USD, you're actually buying the euro. If you are selling Euro USD, you're actually selling the euro. Let me say that again. The base currency is the basis of the transaction, which means that if you are buying the Euro USD currency pair, you are actually buying the euro. And if you are selling the Euro USD currency pair, you're actually selling the euro. Okay, so that's why it's the basis of the transaction. That's why it's called the base currency. Then the quote currency is the value the pair is quoted with. The value the pair is quoted with. Now, in some cases, you will find out that the USD will be on the left-hand side, and then you have another pair on the right hand. So there is a way that they do the pairing. You don't have to care about how they do the pairing. Just know how they do the pairing. Okay, the Euro USD is paired like this. GBP USD is paired like this, which means the GBP is on the left, the USD is on the right. Now there are other pairs. There are other pairs we will see as we go on. Let's just go on first. As we go on, you will see other pairs that have the USD on the left hand side. All right, so that's how it is. But then this one now, the quote currency, which is the USD, is the basis of quoting the price. We said before that this is the price. This is the price quote. Euro USD 1.30. That is the price quote. So this price quote right now is quoted on the basis of USD. What does that mean? It means that this value right now is the USD value that is needed to buy the base currency. Is the USD value, which means is the quote currency value that is needed to buy the base currency. In this case now, 1.3000 is the USD value, the USD amount you need in order to buy 1 euro. The USD amount you need in order to buy 1 euro. Okay, so let's pick another one. Let's pick, do you understand me so far?
Yes.
Okay, now let's pick another pair. USD JPY. Now, if you look at this pair now, automatically you see that the USD is on the left and the JPY is on the right. So which one is the base currency and which one is the quote currency?
USD is the base currency.
Okay.
Then JPY is the quote currency.
Quote currency, okay. Now, something to add there, the quote currency is also called counter currency. The quote currency is also called counter currency. Counter currency. Okay, so the base currency is also called the counter currency, but we will focus more on calling it quote currency because it's more useful for us like that. But this one is the counter is just the counter is the idea that one is against the other one. All right, euro against the dollar, USD against the JPY. That's why they call it counter, right? But let's leave the counter. Let's deal with the quotes because that's what it's more useful to us in our learning. All right. So now look at this quote currency, for example. USD JPY, sorry, USD JPY. And this USD JPY, usually you will find USD JPY would be 1.33, sorry, 133.690, something like that. All right. So now this is the value. This is 133.960. All right. So now this amount right now. This amount, what does that, this amount now, USD JPY equals, let me put equals so that you get it. Equals. Okay, so this USD, this quote right now, this quote right now, what does it mean? What does it mean? Can you explain what it means?
Yes, the 133
yes
is for USD and the 960 is JPY. So the amount we can get the USD is 960.
Okay, no, that's not what it is. Now this one here, 1.1300 is one figure. It's not two figures put together in one. The value of the quote currency is one, but it's absent. Do you understand? The value of the quote of the base currency is not quoted because it is one. One times anything is the same thing, right?
Yes.
Okay, so so that this value you are seeing here is one single value, is the value of the quote currency. This is the amount it will, yes, this is the amount of quote currency it will cost you to buy one one base currency. The base currency is one, but it's absent. Is not quote is not defined, as it were, but is one. All right. So this one now is the value of the JPY. It will cost you to buy one USD. This amount is what it will cost you to buy €1 in dollars. This amount is in dollars. Why is it in dollars? Because dollars is the quote currency. Okay. Now this one, this amount, this price right now is in JPY because JPY is what? The quote currency. Do you understand what I mean?
Yes, yes.
Great. So now let me pick yet another one. USD CHF equals 0.98 okay, 0. So now, can you explain this? First of all, which one? What is the quote? What is the base? And what are they called? What are they called? This. Do you remember what we talked about? The major currencies. Do you remember the major currencies?
Yes.
Okay. Do you remember that
Franc.
Do you remember this one? This one is a major currency. Hello.
Hello. Yes, it is.
Okay, it is. Do you remember what it's called?
Franc.
Sorry?
I said franc.
Chef is called Swiss francs. Okay, it's called chef, but it's called Swiss francs. Is the currency of Switzerland, right? So we said that day.
Yes.
And when you're on that, when you get back to those videos, you see what we said the other day. You see we displayed it on the screen the other day. So this one now, is USD chef, right? So what does this figure mean? Just say, let me know you are catching, you are following.
The code currency for the USCHF.
Okay, this amount now is quoted in what? In which of these currencies?
In chef currency.
Okay, it's quoted in chef currency. All right, and then this is the amount in chef currency that is needed to buy $1. Right?
Yes.
Okay, great.
Yes.
So I'm trying to reinforce it so that you get it. You understand what I'm saying. Okay. So now, that's very important. Then the next thing we're going to now is major currencies. Major currency. We talked a bit about this the other day. Major currencies. Okay. So now major currencies, major currency pairs, sorry. Major currency pairs. Major currency pairs. Major currency pairs. So the other day we talked about, I showed you several of them, but then these are the most important ones. These are the most important ones, the ones I'm going to write now. These are the most important ones. So these are the most important of them. Euro USD, GBP USD, USD JPY, USD CHF. These are the pairs that have the most use, the most value, the most use in the world, which means they have the most volume. You know, we talked about volume the other day. So these are the currency pairs that have the most volume in the world. Euro USD, GBP USD, USD JPY, USD CHF. Do you see anything common among all of them?
USD.
Okay, the USD is a common thing. Okay, great. So now, the reason why these pairs are called major pairs, why are they called major pairs? They are called major pairs because they are the currencies that are they are the currencies with the most use in the entire world. For example, the whole Forex market, 23% of the 23% of the 6.6 trillion on a daily basis. 6.6 trillion. So Euro USD accounts for 23% of the 6.6 trillion on a daily basis that's done in the forex market. The Euro USD alone accounts for that 23% of the entire $6.6 trillion in the market, which means that almost $2 trillion every day is done through Euro USD. So Euro USD is the #1 currency pair in the world. Is the #1 currency pair in the world. Then followed by USD JPY, then USD, then GBP USD, then USD CHF. This is the order in which the volume, this is the order in which the volume, this is the order in which the volume is much on a daily basis. This is the volume, this is the order in which the volume is much. The volume is done on a daily basis. The Euro USD is the #1 most traded currency in the world. The Euro USD is the #1 most traded currency in the world, followed by the USD JPY, followed by the GBP USD, and followed by the USD CHF. Okay? So now, these are the 4 most used currency in the world, most traded currency in the world, right? The 4 most traded currency in the world on a daily basis. Euro USD is #1, USD JPY is #2, GBP USD is #3, USD CHF is actually much smaller than the remaining 3, than the first 3, much smaller, much smaller. Okay. Yes. So now, those are the major ones, and then there's what we call commodity pairs. These are the major pairs. Okay, so let's move. Let me shift this up a bit. So these are the major pairs. Then there's what is called the commodity pairs. Commodity pairs. Now, the other day we said that there are some commodities that are traded in the market: gold, silver, palladium, and the rest of them. I showed you several. I showed you currencies. I showed you commodities, cryptocurrencies, indexes, stocks. Right? Do you remember that? Do you remember all that?
Mm-hmm.
Tell me if you remember. If you don't remember, tell me you don't remember now.
I did.
Oh, you do. Okay. All right. So then there are what's called commodity pairs. Now, commodity pairs are basically pairs that are tied to, they are the pairs of economies that are commodity based. Major economies that are commodity based. So the currencies of those countries are what's called commodity pairs. All right. So these countries are basically Canada, Australia, and New Zealand. Okay, so these currencies, the currencies of these economies are called commodity pairs. The currencies of these economies are called commodity currencies. Okay, commodity currencies. Let me show you what that is. So you have the CAD, and you have the AUD, then you have the NZD. NZD. Okay. So these are called commodity currencies. Now, what are the commodity pairs? Remember, we have to have the currencies to make the pairs. So the commodity pairs now are USD CAD. These are the commodity pairs: USD CAD, AUD USD, and NZD USD. NZD USD. So these are major currency pairs also, but they are called commodity pairs because their economies, the economies of these countries are tied very much to the commodity industry. For example, what commodities do you find in Canada? Oil. Oil is the commodity of Canada. Okay, maybe I should indicate that. So you have oil. Oil is the commodity of Canada. Australia is gold. Gold. In fact, metals, not just gold. Gold, silver, metals. Okay. The same thing with NZD. Metals. Okay. So metals, when we talk about metals, the most important metals are gold, silver, palladium. What other ones? Those are the major ones actually. Gold, silver, palladium. Then when it comes to Canada, you have oil, crude oil. Crude oil. Let me make that crude oil. Crude oil. Okay. So these economies are very, very interwoven with commodity markets. So that's why they are called commodity currencies. And then the cross, the pair they form with USD is what are now called the commodity pairs. These currencies are called commodity currencies because their economies are tied very much to commodities. Then the pair that they form with the USD is what we now call the commodity pairs. Do you understand?
Yes.
Okay, great. So these ones too they are major pairs. They are major. In fact, USD card has far more volume than USD CHF on a daily basis. USD card is far more traded than the USD CHF. USD card is far more traded than the USD CHF. All right. So that's it. But they are called the commodity pairs. They are major pairs as well, but it's because of their connection with commodities that they are called commodity pairs. They are also part of major pairs. So also have it in your mind that they are major pairs. They are part of major pairs as well. In fact, we saw it the other day that all of these are part of major pairs as well. So then you have what are called the major crosses, major cross pairs. Major cross pairs, major cross pairs, or major crosses, or major crosses. Okay, so they are either called major cross pairs or they are called major crosses. Okay, so these ones are Euro GBP, Euro JPY, Euro CHF. So these are the major cross pairs. The major cross pairs: Euro GBP, Euro GBP, Euro JPY, and Euro CHF. Okay, so now the thing with these pairs is that you notice that there's euro in all of them. The reason, the thing there is that
Yes.
these currency pairs are very interconnected. They are very linked to the eurozone economy. They are very linked to the eurozone economy. All right. So GBP, Euro JPY, Euro CHF, they are very linked to euro economy because there you can see the euro pair there. So these pairs, one thing you will know about JPY and CHF is that they are very stable pairs. They are called JPY and CHF are called safe haven currencies. In fact, and USD too. JPY, CHF, and USD are called safe haven currencies. Okay, so they are called safe haven currencies. But JPY and JPY and CHF are very stable currencies. JPY, CHF, and USD are called safe haven currencies. Why they are called safe haven currencies is because whenever there is uncertainty in the world economy, whenever there's uncertainty in the world, investors will go and buy JPY, CHF, and USD in order to stay away from the uncertainties in the world. Okay, so these currencies is where people go and buy. They invest in these currencies when there's uncertainty in the world. Those are the currencies they invest in. All right, that's why they are called safe haven currencies. All right, so USD is a bit volatile, but JPY and CHF are stable currencies. So any pair where you find JPY or CHF, anywhere you find JPY or CHF, you will realize that the movement of those pairs will be tilted towards the other currency. What do I mean? When you have Euro JPY, it means that this currency pair will track mostly what is happening in the euro, because the JPY is very stable. All right? If you have two things and one is very stable, and then they are meant to be meant to counter each other. One is very stable. Most of the time, you will discover that the movement you are going to be seeing is going to be based on the one that is not stable. I don't know how to explain this to you. Do you understand what I mean?
Yes.
Okay, you do. Right. So the same thing with Euro CHF. So the CHF is is a very stable currency. The JPY is a very stable currency. These economies are very stable. JPY and CHF, they are very stable economies. All right. So whenever they are paired with any other currency, you will notice that that currency pair is mostly going to be reflecting what is happening on the other currency, not the JPY. Because the JPY is stable, the CHF is stable. All right, so that's that. So those are currency pairs. All of these are available for trading on a daily basis. But what we are doing is we are defining them so that you know the difference between these currency pairs. What are the difference between these currency pairs? There's actually differences. All right, and then these things these definitions we are doing right now are very important in the sense that these linkages we are making between one currency and the other, between the currency and commodities, we're talking about major currencies, all of these matter in how these currency pairs move on a daily basis. For example, the USD card, the USD card, when you know that the card is a commodity currency, it tells you that whatever is happening in oil, whatever movement is happening in oil, if the price of oil is rising or falling, it is definitely going to affect the dollar, the cards, the Canadian dollar, because this currency is very tied to the crude oil market. So whatever is happening to crude oil is definitely going to affect CAD, which is definitely going to affect USD card. But if you don't know that USD card is a commodity pair, you will think that USD card is very separate from oil, because oil is also a commodity that is traded in the forex market. Oil is a commodity, all right? In fact, oil is one of the major commodities. Oil, gold, silver, palladium, these are the major commodities, all right? So now the price of gold, the movement of gold, when you look at Australia, and you see that Australia is a commodity, AUD is a commodity currency, that is closely linked to gold, it tells you that any movement, whenever there's a major movement in gold, you will see that there's going to be a major movement in AUD USD as well. Whenever there's a major movement in gold, you will see that there's going to be a major movement in AUD USD as well. And then there will also be a major movement in NZD USD as well. Why? Because they are commodity, the movement, they are commodity currencies, they are commodity pairs, and the movement that is happening in those commodities is reflecting in those in the pairs. The movement that is happening in those commodities is also reflecting in the current in the pairs themselves. Do you understand that?
Yes.
Please don't get distracted. Tell them that you are busy. Okay, so that's the reason. That's the reason why we are doing all these definitions for the purpose of clarity, so that you understand why what is affecting what. Because all of these things we are studying right now, eventually we are going to go into the market later on to use them to trade. All right. So when we are using them to trade, then we are going to have all these things in our minds. We are going to know what's going on. For example, an index, we talked about indexes the other day. We said it's a basket of stocks. Do you remember that?
Yes, I do.
Okay. So now, for example, if you have an index that has 30 stocks within it, let's say there's a particular index called the US 30. All right. So it's also called the Dow Jones Industrial Average. Dow Jones Industrial Average, DJIA. All right. Is in the forex market is called US 30. It actually comprises 30 of the largest industrial companies in the US. 30 of the largest industrial companies in the US. Now think about it. If an index comprises 30 individual stocks within it, whenever there's a movement in each of those stocks, will it not affect the entire basket?
Yes.
Okay. So that's what happens. The same thing. It's the same thing when we are talking about commodity pairs. You want to be able to know what is affecting what. What is what the movement of what is affecting another. What is affecting another? Gold is definitely going to affect the AUD. Oil is going to affect the CAD. Metals, gold will also affect the New Zealand dollar. All right. Okay, so now what are the things that why, first of all, why do traders, we discover that most traders, most big time traders actually trade in major pairs. Why do traders prefer trading the major pairs, major currency pairs? So, sorry, major currency pairs. So traders prefer trading the major currency pairs. Big time trader, all kinds of traders prefer trading the major currency pairs. The reason for that is this. Whenever, let me use an example. Let me use this as an example. Now, if you are, for example, you are into a business where you deal in whatever. Let's say you deal in Coca-Cola drinks. You buy and you sell Coca-Cola, right? And then but every time you buy a truck of Coca-Cola, it finishes the same day. Okay, I don't know whether I should use Coca-Cola, but let's just use Coca-Cola. If you buy a truck of Coca-Cola, you usually sell it in a day, right? Now, whenever
Yes.
can you afford to make very little margin on each Coca-Cola bottle or each Coca-Cola crate? Do you understand what I mean by margin?
No.
I mean profit, small profit. Okay. So, for example, you can decide that you want to make 2 naira or 1 naira from every transaction, from every bottle. You will still be making money, right? Because you are doing a lot of volume, right? On a daily basis, your crates, you are selling thousands of bottles, and you are making 2 naira, 3 naira, 4 naira from each one. At the end of the day, what does it do? It runs into a lot of money, right?
Yes.
Okay. So, but then what if what I'm trying to say is that you can afford when the volume you are doing, volume you are doing on a business is very quick, you can afford to charge very little. You can afford to make very little money on each unit of the product you are selling because of the volume, the speed at which you are doing the volumes. But imagine that you sell real estate, you sell houses, and then you usually sell one house once you usually sell one house in 3 months. So it will take you 3 months to sell one house. Can you afford to make small money on that? Can you afford to make let's say the house is 10 million. Can you afford to make 100,000 on that house? It's too small, right?
Yes.
Because you are doing only one sale in 3 months. You cannot be making 100,000 naira. So you want to make one sale, and that your sale is going to run into millions because that volume is your volume is very small. Your volume is low. You are making one sale it's taking you a long time to make one sale. All right. Now these two businesses I describe right now, they are businesses that people do. All right. And then it doesn't mean that one is better than the other one. It's just the nature of the businesses. All right. So it's the same thing that happens when we talk about major pairs. We said that major pairs are the most traded pairs in the world. The Euro USD, for example, is the most traded pair in the world, right? So now, if the major currency pairs are the most traded pairs in the world, what that means is that in order to trade, in order to transact, to do this trading, the transaction cost is usually very small. The transaction cost is usually very small. Now, before we get into that, whenever you want to trade the forex market, okay, let's just complete this so that we don't jump the thoughts. Now, the reason why traders trade major currency pairs is because of low transaction cost. Low transaction cost. Low transaction cost. Right? So now, whenever you want to trade in the forex market, you need a broker. You need a broker to trade in the forex market. The broker is the intermediary between you and the market, as it were. The broker is your access to the market. The broker is your access to the market. It's just like, for example, if you want to trade in the stock exchange, you can't just go to the stock exchange in Lagos and walk inside and say, I want to buy shares. No, you can't do it. You have to go through a broker. So a broker has a license. A broker is authorized and licensed to deal in the business, to deal on behalf of their clients, which means that they can buy and sell different assets, different currency pairs on your behalf as a client. Okay? But then, how do they make money? They make money through transaction costs. They make money through commissions from charging you. Whenever they make a buy, whenever you place a buy trade, they will charge you something for it. Whenever you make a sell trade, they will charge you something for it. So that's how brokers make money. So that is the cost of your trade. That is the cost of your trade. And then this cost we are talking about is called the spread. is called spread. Spread. So this is something we're going to discuss further in a different class. Spread. Spread is the transaction cost of your trade. So spread is the transaction cost of your trade. This is how much a broker, this is what a broker charges you every time you trade. Every time you make a buy trade or you make a sell trade, the broker will charge you what is called a spread. And that spread is basically your transaction cost. It's basically how they make money. They charge you to help you execute the transaction. It's just like you want to send money from one person from your account to another person, and the bank charges you a fee to make the transaction. If you don't have the bank, you won't be able to send the money to the person. So the bank does not take your money. The bank takes a charge for helping you do it. All right? That's the way brokers are too. Brokers help you make buy or sell trades. Then they charge you a commission called spread. So now, when I said that traders prefer major currency pairs because of low transaction costs, this is what I'm talking about. So when you are trading in the major pairs, we've discussed the major pairs. When you are trading on all these major pairs, your transaction cost, which is your spread, is usually very, very small. Very small. But if you are trading in what is called the exotic pairs, when you are trading in exotic pairs, I'll show you a few examples of exotic pairs. When you are trading in exotic pairs are usually very expensive. They are not the major, they are the minor pairs. So when you are trading on the minor pairs, your cost of transaction, your transaction cost is usually very high. And the reason is the kind of illustration I gave you earlier. Because the volume is low, the transaction cost is high. When the volume is high, the transaction cost is low. When you are selling Coca-Cola and you are selling a lot in a day, you are doing a lot of volume. You can afford to charge small. You can afford to lower your transaction cost. But then if you are making a sale of houses or properties and you sell one once in a while, you cannot afford to keep your cost low because you will not be making money. In that case, you will not be making money. So whenever the volume is high, the transaction cost is going to be low. Whenever the volume is low, the transaction cost is going to be high. So this is the reason why traders prefer trading major pairs, because their transaction cost is low. Their transaction cost is low. If you are trading minor pairs, sometimes the profit you make, the whole profit you make, will not be enough for you to cover the cost of your transaction. Sometimes the whole profit you make on a trade will not cover your transaction cost. So in that case, what sense does it even make for you to be doing the transaction, a monetary transaction, when you are going to be charged more money than you make? Does it make sense?
No.
Yeah. So that's the reason why it's better to trade in major pairs. And the truth is that it's not as if the minor pairs make more money than the major pairs. They don't make more money than the major pairs, right? So that's the thing. So if you know that the minor pairs do not make more money than the major pairs, what is now the point of trading the minor pairs? Right? So you trade the major pairs because of low transaction cost. So that's very, very important. That's the reason why traders prefer trading major pairs. And you as a trader, as an upcoming trader, your go-to is to pick the major pairs and only concentrate your efforts on the major pairs. That's all. Okay?
Hello?
Are you still there?
Yes, I am.
Okay. So now, what are the things that affect the movement of major pairs? Now, before we looked at something earlier. We looked at something earlier, and then we looked at this when we're talking about price quotes. Look at this price right now, 1.130000. Now this price is not fixed. This price is not fixed. All right, this price is always changing. Let me give you an example. Look at right now, we are on a, can you see this? Can you see this?
Yes.
AUD USD 1 hour chart, right? Okay.
Yes.
So now, since we are on this chart, look at this right now. You will see this blue. Can you see this blue line, this green line or blue line?
Yes, yes.
Okay. So now this is the current price of AUD USD, the current quotes. So if we are to quote AUD USD now, we are going to quote it as 0.73159. So these numbers we are putting, they are not arbitrary numbers. They are actually numbers you will find on your charts. All right. So if we are to quote AUD USD now, this is the price quote of AUD USD. AUD USD. This is the price quote of AUD USD. So it means that it will take you $0.73156 to buy the AUD. Is that right?
Yes.
Okay, fine. So now this price is always changing, always changing. As you can even see right now, can you notice it's changing?
What do you say?
Do you notice that this price is changing? Can you see it?
Yes.
Is it changing? Can you
Yes.
see it?
Yes.
Okay, fine. So now, why does it change? Why? What influences the move? If we any of these charts we go to right now, this is the same thing you are going to see, except the market closes. It's only when the market closes on Friday night. It's only when the market closes on Friday night that you're going to see that the market is going to be start to be still. But as long as the market is not, as long as as long as it's during the week, the market is going to be moving. All right, this price is going to be moving. So now the thing is that what makes these movements happen? These movements we are talking about, what makes them happen? You will see it in Euro USD, GBP USD, all of them, you will see this movement. What is affecting the price of these assets? What is affecting their price? All right, so let's talk about that now. Okay, so what are the factors? What are the factors? What factors affect the rate? Currency rates or quotes. So what are the factors that affect the currency quotes or the currency rates? All right, so this is a currency rate, is also a currency quote. Okay, but more professionally, you call it the currency quote, right? So, but what are the factors that affect the currency quotes? Okay, so first of all is interest rates. Interest rates. Interest rates. So interest rates are usually they are rates that are released by the central bank of a country every month. In Nigeria, there's what is called the MPR, okay, the Monetary Policy MPC, Monetary Policy Committee. There's the MPRO, the Monetary Policy Rate. So the monetary every month, the central bank has a committee. This committee is basically is a committee that comprises the central bank governor and then a few deputy governors, the deputy governors of the central bank, and some CEOs of very top banks in Nigeria. Okay, the CEO of very top banks like Access, Zenith, First Bank. Those guys are part of what they call the monetary policy committee. So every month they will have a meeting, then they will discuss the interest rates. They are the ones that fix the interest rates that banks pay you. They are the ones that fix interest rates that banks usually use for lending purposes. Lending rates, they fix lending rates as well. Okay, So those are what they do. So that's what's called interest rate. It's usually once a month. For the US, it's released once a month. For Australia, it's released once a month. All countries release these interest rates once a month. So whenever these interest rates are coming out, investors are going to be watching. So whenever these interest rates are released, you will notice that there's a lot of movement in price. The reason is that any interest rate that comes out affects the economy. So as long as if we said the other day that the economy, the currency of a country is very, very tied to the economy. It's like a share in the economy. Do you remember that? We said the currency is like a share in the economy. Do you remember that?
Yes.
Okay, so that's the thing. So every time something comes out that's going to affect the economy of a country, it will affect the currencies. You will see the currency is moving. It will either move down or it will move up, all like that. So interest rate is one of those things that that you will see. So the next thing is economic data. Number two, economic data. Economic data. So economic data has to do with the data releases. For example, in the US, there's every month they release what they call the employment and unemployment numbers. So every month they will release, oh, these are the number of unemployed people. These are the number of new jobs that were created last month. These are the number of people that are employed. This is the employment rate. So investors will see that, we see and look at it and say, okay, did the numbers increase? If the employment numbers increase, it means that more people got jobs last month. It means that the economy is doing well, right? So if the numbers for last month are, if from numbers for the current month rate is lesser than the numbers for the last month, it means that some people have lost their jobs. And if people lose their jobs, it means that the economy is not doing well. So all of these things will affect the currency of that economy. So now these are two websites that you need to go to, two websites that will tell you what to do, will tell you where these economic news and interest rates, where they are released and where you can find them every month. So you have a website called www.investing.com. Investing.com. Okay, that's one. Then two, you have www.forexfactory.com. Factory.com. Okay, so sorry. So these two websites are very, very important when it comes to finding out economic data. So this economic data I'm talking about, every month they are released, but they are shown on these websites. On these two websites, you're going to find them all the time. Whenever you go to, for example, you go to Forex Factory now, you will see the news, the economic news for today. There's news for every day. So you will see the news for today. If you go to investing.com, you will see the news for today. All right. So in a later class where we are talking about market analysis, we discuss this more. But I just want you to know them. You can go and take those websites and go and check them out, right? And see what is on those websites. All right. When we're talking about a market analysis later, we will discuss them further. All right. So other things that affect the market, politics. You know, like right now, we just had the elections in the US. It affected the US dollar very heavily. In fact, it's still affecting the US dollar because right now, the current president, Donald Trump, he has not agreed that he has been defeated. So all of that is upsetting a lot of things in the US dollar right now, in the US economy right now. He has refused to accept that he has been defeated, you know, and all that. He's saying that he has not been defeated, the election was rigged, all those kind of things. So all of those things matter. They affect the economy. They affect and anything that affects the economy will affect the currency of an asset. The same thing in Russia. The other day, there was a rumor that the president of Russia, Vladimir Putin, got sick. So people were looking to use that data to trade on the Russian ruble. The Russian ruble is actually the currency for Russia. People were looking to use it to trade until some other people said, "Oh, watch this, it's actually not true," and all that. So if assuming it was true and he actually has Parkinson's disease and he cannot move, and he's still the president, what's going to happen? People are going to be looking to speculate. They'll be looking at, oh, so what's going to happen now? So is he going to leave? Is there another person going to come? So what's the other person that is coming? What's he going to do? What's going to happen during the election? All those things will be affecting the economy and therefore affecting the currency. Okay? Then there's volatility. Volatility is basically people buying and selling. Whenever there's a lot of traders in the market, there's going to be a lot of volatility. Volatility basically means price movement. Volatility. Volatility is price movement. Price movement. So the more the price movement, the more the volatility in the market, the more the movement you will see in the pairs. The more volume, the more the number of people in the market at that time with more volume in the market right at that time, you will notice that that's when a lot of movement will be happening. For example, look at this now. Let me show you something. Look at this right now. Do you see these movements right now? These black, green and red
Yes.
indicators. Okay, they
Yes.
are called candlesticks. They are called candlesticks. So candlesticks, that's what they are called. We'll discuss them sometime later, but they are called candlesticks. So now these candlesticks, do you realize all of these candlesticks are formed in the same period of time, which means that it takes the same time for this one to form, this long one, than it takes for this small one to form. Let's look at this small one. Let's look at this small one. Do you see this small one? This one?
Yes.
It takes the exact same time for this one to form than this one to form. It takes the exact same time for this one to form than it takes for this one to form. So what's the difference? The difference is volatility. During the time this one was forming, there was a lot of volume in the market. A lot of buyers, a lot of sellers were in the market at that time. There was a lot of volume. During this time, there was so small volume in the market. You see? So that's what we mean by volatility. All right? So whenever there's volatility, there will be a lot of price movement. Okay? So do you have a question?
No.
Okay. Do you ever ask questions in class?
Yes, I do.
Okay. All right. Okay, because you always say no. But that's fine. That's fine. If you understand it very well, then that's fine. Okay, so that's where we're going to end our class for today. So I will this session has been recorded.